Welcome to Dollars and Cents with Freedman Financial, the home for financial advice in a language you can understand. Created by Marc Freedman of Freedman Financial, he and his team of certified financial planner professionals will discuss timely topics that help individuals and families make smart financial decisions. And now, get ready for this week's edition of Dollars and Cents with Freedman Financial.
Welcome back to another edition of Dollars and Cents with Freedman Financial. My name is Marc Freedman.
And I'm Marion Gilman.
And we're here to provide you with some financial advice in a language you can understand. You know, as we head into the fourth quarter of the year, we hold once a quarter a webinar for our clients. And actually, if you're listening to this podcast, you're welcome to join our webinar as well. You just learn about it through our newsletter.
Absolutely.
But as we prepare for this webinar, we ask our clients to send questions. And one of the questions that we got was really compelling in that there's a lot to pull out of a simple one-sentence question that they asked. But let me read it to you, and then Marion and I will kind of react to it and share some insights that I think you might find very helpful. So this question came from one of our clients. It says, "Isn't an overvalued stock market in a poorly performing economy a sign of impending recession or worse?"
Well, what's worse?
Well, what's worse? First of all, I read this and I'm thinking, is that a true statement?
Well, it's a question.
It's a question, right?
But some of the assumptions might not be exactly our assumptions as to what the picture is today.
Right. So you break this down.
Or your assumptions.
Right. The first part, isn't an overvalued stock market. A, is the stock market overvalued?
And that's very difficult to say. There are some, and it's funny, I was trained as an economist, and, the economists are notorious for having vastly different opinions.
Yeah.
So you can find an economist who will tell you, absolutely, the market's way overvalued, and you can find others that say, oh no, there's a lot of value still to be had in the market.
Right. Some will use this term called price to earnings ratio. You heard this expression PE, the price of the stock to the earnings. And some would say when we had the dot-com boom, remember that? The big growth pattern that happened when dot-com was really big in the late 1990s and into 2000, those PE ratios averaged around 60 on the PE schedule. Now,
well, wait a minute though.
Or even, okay.
We have to say, well, what part of the
You're absolutely
stock
right.
market?
There
was a part of the stock market that 60, 70,
60,
right?
70, or hundreds.
Exactly.
Hundreds in that area. And a lot of that was technology driven, wasn't it?
Absolutely. And the same might be true today, where some of those high growth tech stocks, the PE ratios are very high.
Absolutely. Because some might argue that the average PE should be around 18 to 20 something.
That's been the average historically.
Right, but that's for everything.
Right.
But there are certain sectors of the market that get overvalued, if you will, or as listed here. So when someone says the stock market is overvalued, just because it's up doesn't mean it's overvalued. However, there could be sectors of the market that are overvalued.
Exactly.
And so there's something to be said that. But to say that the market is overvalued, is it? Because I feel pretty comfortable that where the market is today, there's still a lot of room to grow.
And, in all honesty, there are a couple sectors of the market that have really lagged behind this year, namely small company stocks and value stocks.
Absolutely.
International has actually lagged behind for several years and this year has finally started to catch up. But there are a lot of sectors that I would definitely not classify as overvalued.
So when someone's investing, Marion, are they generally investing in a sector, or are they investing in the market? Are they investing in a diversified portfolio, an asset allocated portfolio?
Right. Well, I can tell you in our office, we make sure that everybody in this office, in portfolios here, are well diversified. There is no one that has an exposure that is just completely weighted towards tech stocks. That would just be suicide. No, I mean, it could be dangerous,
that's for sure.
Dangerous, absolutely.
But to this person's point, isn't an overvalued stock market, and we'll continue the rest of it, in a poorly performing economy a sign of impending recession or worse? I can assure you this, whether it's an overvalued stock market, an undervalued stock market, no matter how you define it, the market's going to go down.
No question.
I can assure you of that. Now,
We don't know when.
Now, what constitutes a recession or worse, or a crash, or a free fall, or a plummet? What are the triggers to use those words?
Well, in all honesty, it has nothing to do with the stock market.
Absolutely.
A recession is classified as 2 consecutive quarters of declining GDP growth.
Well, hold on. What's GDP growth?
Gross domestic product.
Which means
So
what?
It's the economics in the United States. Everything that is produced in the U.S. Constitutes gross domestic product.
So here's a formula for you, because I remember this from my macroeconomics class,
Good
first
for
year
you.
in college.
Wow.
The formula was C plus I plus G, C plus I plus G minus E minus M.
Well, that's
plus E minus M is what it was. C plus I plus G, that's in brackets, plus E minus M. So let me explain to you what that means. The C plus I plus G is the amount of money that consumers spend.
right.
The I is the interest that gets paid on bonds, right?
Bonds, yeah.
And the G is the money that the government spends. So consumer spending, interest payments, and government spending.
That constitutes revenue in the country.
Right. And then you have the money that you get, exports, what we export out. So when we export stuff out, we get money in, minus what we're importing, because we're paying for goods that we're importing.
Right.
So it's the net of the exports import
That's
plus
right.
C plus I plus G. That makes up the gross domestic product.
Right.
I remember that from my freshman macroeconomics class at the University of Massachusetts.
I'm impressed because you actually got the entire equation as well. Most people leave out the E minus
M.
I. E minus, yeah.
They
right.
call it M, but yeah.
Yeah.
But you could call it I. It doesn't
Well,
matter.
there's another I in the equation
Right.
earlier, so that's
what they
why,
call
yeah.
it M.
Yeah.
So,
Yeah, but in any event, so it really doesn't depend on what's going on in the stock market. That's entirely different. Theoretically, it should coincide with what's going on in the stock market because stocks grow when they sell more product. Companies grow, I should say, when they sell more product. So if consumers are spending more and buying more stuff, then the company should reflect that. But that doesn't always happen.
But Marion, regardless of whether we're in an overvalued stock market, undervalued stock market, no matter how you define it, what you think, what you hear,
Right.
what's the likelihood that the market will drop 10% in any one given year?
It's actually, I think it's close to 80% or 90%.
It's almost a certainty.
Yeah. We have a 10% decline in the market typically every year, and we've actually had a 10%.
We already had it this year, but we seem to forget.
Correct. Yeah, and we can have 2, even 3 in the course
Right.
of the year.
You may remember the beginning of April, the market dropped, what was it, mid-teens?
Yeah, it was March into April, yeah, exactly.
When President Trump announced that he was going to set up with tariffs.
Yep.
And then all of a sudden, everything readjusted itself, and that's what happens. The market reacts to news, and then it readjusts itself. Back and forth, back and forth, back and forth. Now, what's interesting is we look at the portfolios right now that we have in our office. Typically, a lot of our portfolios are, call it 60-40, 60% in the stock market, 40% in the bond market, plus or minus on each side a little bit. But the returns over the past few years, as long as you're in a diversified portfolio, have held up pretty good. I mean, you're in.
We've had really good returns over the past 3 years.
Pretty much almost in the low teens,
Yep.
dare I say, or the
Each year.
tens each year. In 23, 24, and heading into 25, we're almost projected to do that, though I'm not making any guarantees here.
We
But
still have 2.5 months left,
What
right?
people forget, though, is in 2022, we had negative returns in the 10 to 18% range for a stock and bond 60-40 portfolio.
Right.
And most people will say, well, Mark, that was because of COVID.
Was it?
Wasn't, was it, Marion?
It was not because of remember, COVID was 2020.
Right.
And 2020, during COVID, we did have a significant decline in the portfolio once COVID really hit and the shutdown happened. But it recovered by the end of the year. The market.
They called it a V-shaped recovery, meaning it went
Exactly.
down and up.
Very fast,
Right?
yeah.
But in 2022, we had this negative returns generally in portfolios.
We did.
And
yes.
what was the cause of that?
Both stocks and bonds.
Right.
Correct. Yeah.
Because remember, interest rates, remember what mortgage rates were in 2022 early on?
Right.
2%, 3%, and then they shot up to almost 7%.
Yeah.
Money at the bank was paying 0%.
And we didn't have all those COVID funds. The influence of all that excess money from the government coming in from COVID. So all of a sudden, all of that stopped. Interest rates went up, and everything else went down.
Yeah, but the market recovered. The market
Quickly.
always figures out a way. Well, I can say historically, the market has always figured out a way to recover.
Right.
And I believe that will continue to happen in the future. So back to this person's question of, isn't an overvalued market in a poorly performing economy a sign of impending recession or worse? There's a lot in that question there.
Right.
And I think the answer is no.
That sounded very tenuous there. I will say, I wanted to bring up one other point, and that is that the market in general, or any sector of the market, there is this phenomenon called overshooting. And it happens all the time. In other words, the market sort of gets euphoric and goes up too high. And that might be what's going on in some of these AI tech stocks at times, where everybody's so excited about them and the possibilities. And you know what? There is a lot to be said for that. But everybody wants in all at once, so the prices go way up. And then somebody comes out and says, oh, this is bad, and all of a sudden it goes the opposite way. And it goes too far up probably, and it goes too far down as well. And they call that overshooting. Happens all the time in every market.
You know what? It also happens in the political landscape.
It does.
It does.
Absolutely.
No matter who's in charge,
Yeah.
we overshoot one way, then we overshoot the other way, and we start moving the pendulum back and forth. And it allows, as the general public, an opportunity to step up to the plate, vote, make some decisions to swing the pendulum one way or the other. And that's what ends up happening. I mean, that's the rhythm of the market. It's the cycle of what goes on in the world, economically, politically, all over the place.
There are countries that are in favor, countries that are out of favor.
Absolutely.
Again, and it changes.
All the time.
Yeah.
But going back to the same sentence, and I know I'm sticking with this thing a lot. The person wrote, in a poorly performing economy. Now, are we in a poorly performing economy? Well, it's a question that has been asked of us by many people that we've seen. And recently in our newsletter that we put out every Friday, 10:30, it lands in your mailbox. You can go to our website, freedmanfinancial.com, put in your name, your email address, and get our free weekly newsletter. But there was a story about something called the K economy. And Marion, maybe you can help people understand what that means, because that addresses the perspective of someone who says we're in a poorly performing economy.
So the K economy is how economic perspectives split given your income level. So as we all know, there's a wide variety of income levels in the United States, and there can be very diverse viewpoints of the economy depending upon where you stand. And what has been shown right now is that those who have higher income levels, at the higher income levels, they're still spending. They're still going along as they always have. They still have a very positive view of the economy currently because they have jobs and they have substantial incomes. On the other side of the equation is the lower income people who maybe they've lost jobs. Maybe because of inflation, their salaries have not kept up with that inflation, so they can't afford what they were able to afford a couple of years ago. So their perspectives are very different as to how this economy is moving forward. And they have a rather negative outlook, under 50% growth outlook of the economy.
Yeah.
And I can't remember the
so I think the number was
is
that 65 some odd percent of people earning with a good income, whatever you want to call a good income.
The higher levels of income.
They're saying the economy is going just fine.
Right.
Yet only 40% of people who have a lower income don't feel comfortable that the economy is doing well.
Only 40%.
Right. But think about
Right.
this. You know, we might say, oh, the economy's doing well or the economy's doing poorly. When someone says that, you might ask that person, well, how is the economy impacting you? Is your statement about the economy a statement about what you believe the world situation is, the country situation, or the economy and how it impacts your wallet? Are you still able to go on vacations? Are you still going out to eat? Are you buying the things that you want at the grocery store? Certainly at the gas station, the cost of gas is certainly less. But you know, certain things are more. They just came out with a report that said the average new car is now hit the number of $50,000 to buy the average price of a new car. I mean, it's gone up. Look at the value of your house. I bet your house has increased in value pretty significantly. Absolutely. Does that mean the economy is doing poorly because your house has gone up? No. I mean, it's all perspective. That's what this is all about. And what we try to share with our clients is financial advice in a language you can understand to give you that full perspective. So if now is the time for you to get serious about your financial planning or investment management needs, we hope you'll give us a call. 978-531-8108. That's 978-531-8108. Or sign up for our newsletter. Go to our website and get the information that we're sharing here. We provide our podcasts through the newsletter as well. You can also go to any of your favorite streaming platforms. Look under Freedman Financial, dollars and cents. You can get, I think it's 14 years of podcasts and radio shows.
That's kind of scary.
It is, but it's all there. You can see how well we've done. But you can sign up for our newsletter, freedmanfinancial.com. That's Freedman.
Too easy to do.
Financial.com. Go to the bottom of any page, put in your name, your email address, and you'll get our free weekly newsletter called Planning Pointers every Friday, 10:30 in the morning, Eastern Standard Time. And we've been doing it since March of 2009. That's going to do it for us this week.
Sounds good.
All right, we'll see you again next week. Oh, next week, we've got a special podcast for you.
Oh, exciting.
I had to add, because we're going to be on vacation in the week that's coming. And so I was in Hawaii a few weeks ago. And I had
Life is tough.
Yeah, I know. I had the opportunity to ask the question, what if I could interview the CEO at LPL Financial? And so I had an opportunity to talk to Rich Steinmeier, CEO of LPL, pulled him aside in Hawaii and asked him to give me 15 minutes of his time, and he did. And so we're going to share that interview as part of our podcast next week. That's going to do it for us this week. Have a great day, everybody. We'll see you again with more Dollars and Cents. Have a nice day.
Enjoy.
During today's episode of Dollars and Cents with Freedman Financial, your host may have discussed specific financial planning and investment ideas that are for general information only and not intended to provide specific advice or recommendations. Please remember that investing involves risk and may include loss of principal. Always consult a certified financial planner professional, qualified attorney, or tax advisor prior to investing to determine what is appropriate for you. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC.